No one has an ethical, moral, or patriotic duty to pay more taxes than they owe. It's everyone's right to understand the rules and work within them. And if you can take advantage, then you should. No one has a patriotic or an ethical or a moral right to pay $1 more than they should. People that gain from the tax laws are just those that understand the rules the best. The rules are the same for everybody.
Hi everyone, you're listening to Investor Report podcast. My name is Alexandra Szuszkiewicz and our guest is Nate Bradshaw.
That's
Am
right.
I saying it right?
That's right.
Yes.
That's right.
Okay.
Excellent.
Great. Please introduce yourself to the audience.
Yeah, for sure. My name is Nate Bradshaw. I am the Chief Operating Officer at B10 Capital. B10 Capital is a tax strategy firm and a capital impact firm whose mission is to help the builders, creators, and innovators of the world have the resources that they need to build, create, and innovate.
Awesome. So what numbers describe your business?
We have helped builders and creators and innovators have about $500 million of additional capital to continue to build, create, and innovate in our business. You know, last year we did about $100 million in impact for our clients, and we continue growing year over year. We've been in business for about 6 years, and but really started to see a lot more exponential growth over the last 3 years or so.
So could you tell me briefly how did it all started? Like how you came up with this idea?
Yeah. So all of the original founders of B10 Capital, there's 4 original partners that are still part of the firm. Myself, my partner Russ, my partner Don, and my partner Scott. Scott and Don are professionals with letters after their names. So Scott's an attorney, Don's a CPA. My background is as an e-commerce entrepreneur, and my other partner Russ, he's a technology entrepreneur with multiple exits. But all of us are very entrepreneurial, and all of us have a shared passion for entrepreneurship, the builders, creators, innovators of the world. I mean, the whole thing really kicked off with one of my partners, Russ, after he had an exit event, and he paid a lot more in taxes than he legally needed to. And being educated about that by our other partner, Don, that was when Russ was like, we need to start a firm to make sure that other builders, creators, and innovators have the education that they need and the resources that they need to be able to keep and preserve more of that capital that they're legally allowed to keep. And that was, kind of the initial inception of the business. It was really Russ kind of collecting some of his friends. My perspective, right? At the time when he approached me, I'm like, I'm not a CPA or an attorney.
Yeah.
And where do I fit in the mix? But he was looking for to assemble a team that not only understood the compliance side, legal, tax, but also understood the operations side and the entrepreneurship side, how we could help translate complex tax, complex capital impact strategy into entrepreneur and make it a little bit more accessible. And so my focus as the Chief Operating Officer, I really focus a lot on the operations of the business, on building efficiencies, and really trying to create the best customer experience possible. Hospitality is one of our core values, and as a business. And so, we really aim to provide the best hospitality in all of finance. That's really one of our missions.
Great. Okay, so what are the strategies that you actually implement?
Yeah.
If you could start with like the easiest one that
Sure.
our audience could implement, maybe not right away,
Sure.
Something that is the easiest to understand.
Before we get into some strategy, let me give a couple things real quick, if we could, just for the audience to know. One is the importance of an advisor. Okay, so everyone that's out there listening right now, the advisors that are in your corner are some of the most important and critical relationships. CPAs, the attorneys that are in your corner. So not only are we not going to have enough time today to get into the nitty-gritty details of how anyone listening should, do it themselves, any of these strategies. Even if you could, I'm not giving that advice. You need to make sure any of the stuff we talk about today, if it's interesting, take it to your advisors. Get them to review it. Make sure that you can have people in your corner that are trained in compliance execute this for you. right? And that's another perspective from me, right? I'm not giving any tax or legal advice today on what anyone listening should specifically be doing. I'm going to give some feedback on what others have done, other things that we've helped others do, but we're not specifically outlining for anyone today, go do this. Take this to your advisors, get their feedback and advice, and then explain to them your objectives, and they can really help shape that for you. And that leads into kind of my third thing I want to just say. Most of our business comes from referral from other advisors that are working with clients on specific objectives and transactions that they're going through. Some of our best referrals come from our CPA partners. So at our firm, we don't do prep and file work that most CPA firms focus on. We focus more on the strategy side of capital impact and tax. And it's a different type of job than what your CPA is going to be focused on. And so what I want to just caution the audience as well, when you hear this stuff and you go and take some of this to your CPA, they're likely going to be familiar with some of this, but they may not have the time or bandwidth to be able to execute on some of this for you. Or, don't go to them and go, why didn't you bring this up to me? The job of your CPA, their main focus is on the accounting side. They're a certified public accountant. They're focusing on the accounting of your business or your personal finances. And so, don't go and beat them up. Their job is not to focus on strategy all of the time. They have a lot of clients. Typically, it's low margin, underappreciated, underpaid work, right? They're work to the bone. And, for you to go and to give them a hard time about not bringing up some of this strategy is really the wrong way to approach it. In our business, the analogy we commonly use that people really understand is like the medical profession. Your CPA is like your primary care physician. They provide your primary care. You need a diagnosis on your health, you're going to go see your primary care physician. But if you need like heart surgery, no one in the world expects their primary care physician to perform the heart surgery on this. Of course, they're going to send a referral to a heart surgeon. The heart surgeon does not become your primary care physician. He doesn't replace your primary care physician, your family doctor. He performs the surgery, and him and your family doctor work together for your benefit. That's the way more of those people need to think about their relationship with their CPA. You really need your CPA as your primary care physician, and you shouldn't beat them up for the fact that they're not also your heart surgeon. Be okay with the fact that they're going to work with a firm like ours or others that are like us to be able to handle both sides of that for you, the primary care and the surgery, and that as a team, we're going to execute on that. So I just want to make sure no one leaves this call, calls up their CPA and starts beating them up for not bringing this stuff up. That's not really their primary job. It's to focus on the accounting. So we love our CPA friends, and we're out there just saying, take care of your CPAs, okay? They're good people. We support them. We have lots of CPAs on staff, lots of attorneys on staff. We don't function as a CPA firm in the prep and file side, but our focus is on being a complement for the strategy.
Love it.
So maybe now we get into strategy.
Yes, let's get to the strategy.
Does that sound good?
That's perfect.
Okay.
Thank you so much for explaining everything.
Perfect.
That's really important for the audience as well, because sometimes they're listening to a lot of advices on the internet, and they just take it for granted. But that's good to mention.
And I think, and actually that point you bring up too, before, as we're getting into strategy, I think it's important as well. So if you had asked about strategy 4 years ago, there would have been some strategies that on the internet people would have been looking a lot, finding a lot of, or that I might have even brought up today as a good idea. Things like a conservation easement, or a monetized installment sale, for example. So strategy in tax, I guess the point I want to make the audience aware of as well is like, there's bad actors everywhere. There's people that abuse strategy, that take it too far, that don't remain in compliance. And so just because someone can tell you that they can even help you with a thing, you really need to perform your due diligence on the quality of their firm, who are their partners, what kind of credentials make up the firm, because you could have, say for a conservation easement, which again, we don't do, and most professionals nowadays don't promote conservation easement because they're on the IRS's Dirty Dozen list. But for a long time, conservation easement was a very popular strategy. It's not illegal.
Yeah.
It's just that so many people have abused that strategy.
Pushed the line too far.
Pushed the line too far that now the IRS looks at every single conservation easement and they guarantee an audit on that to make sure it's done in compliance.
Yeah.
Right? And so anything you hear today too, someone like, oh, I can help you with that. You still need to do your due diligence because just because again, a conservation is not illegal and it exists doesn't mean that everyone's going to be in compliance with it. Same thing with like a monetized installment sale, which now is on the IRS Dirty Dozen list. Some of the stuff I'm going to bring up today could eventually get to that point if there's enough abuse where people are really not in full compliance on that. Okay, so I think that that's the importance of an advisor. That's why you want good advisors in your corner. So, but let's start off with one of my favorites that is very popular, but totally also underutilized. For those that know about it, they love it, but it's so underutilized. And this is really one that your audience, if they're in a position for this to be relevant for them, can make a huge impact. And that's really looking at section 1202. You're also gonna find this with QSBS, Qualified Small Business Stock. And the idea is that the US tax code has created a provision to encourage the creation of small business. So when you are starting a new company, specifically as a C Corp, okay, you have to remain in compliance with it as a C Corp because of the way that C Corps issue stock. You can be an early employee of the company, early investor in the company, being able to get access to this stock. But you can take a 1202 exemption, basically, where you file some paperwork saying that you are that this stock, you are putting it under this provision so that as the value of the company grows, if you ever sell that stock at a future date when the company has improved its valuation, that up to $10 million of that stock sale can be tax exempt.
Whoa.
It's pretty incredible.
Whoa.
So as a new founder, you're starting a company, you start a C Corp, you have to do it right at the beginning. That's why so many people underutilize this. You have to know about this, talk with your CPA, talk with some advisors to get your 1202 filings done so that all of your stock can be eligible to be part of this program, so that as you go raise money and you start providing value in the marketplace and you grow the value of your business from when you started it, when it was worth nothing, but now it's worth say $50, $100 million, you sell it. Let's say that you sell it for $100 million, you own $20 million of the stock. If you had taken this provision early on, then the first $10 million of that $20 million sale, completely tax exempt. You're only gonna have to pay tax on that additional gain.
Nice. So if I understand it correctly, you fill out the papers and all of your investments in stock will basically be covered. For just this one?
Just that specific one.
Okay.
You're basically applying the provision to this stock.
Okay, so
this specific stock.
You would have to create, fill the papers for every single one of them if you have a bunch.
That's right. And again, this isn't going to be something that you're applying to publicly traded stock, because again, it's the stock of a company that is a small business early in its life cycle, right? This is not a provision that you can take because, stock becomes new to you. You buy some Apple stock. Oh, I want to apply this provision. No, you can't do that. Apple's too big. Their stock doesn't qualify. We're talking about a new early stage company that's brand new, or, and when you're getting access to that stock while they're still a small business, while they're still very small, underneath a certain threshold of income, that's when you're going to be able to do that. Okay. So
do you have any example of a company where you actually
I mean, this, again, we work with companies all the time in this kind of instance. And this is going to apply not only to that founder, but also early employees in the company. We're recommending to the founder, hey, early employees of the company, send them over the information. When you hire somebody and you issue them stock, get them over to us so that we can make we can get these provisions going for them. Same thing with early investors in those companies as well, because those early investors that are buying stock in those businesses while the company is still small, they can also take an election on that.
How small needs to be the company? Is there any threshold?
Yeah. I think, you're going to have to be looking at least underneath 10 million, right? Yeah. In size, but really, you have to do this when you get issued the stock, when you first get issued the stock.
Okay. Mm-hmm.
So like you can't wait as a founder until you've grown and then go ahead and do this. Like you need to, when you first set up the company, that's when you need to go ahead and take these elections and these provisions.
Are there any hooks, any like things that they need to look out for?
Just make sure you're working with a qualified advisor. I mean, really, it's a very simple program. It's built into the US tax code, section 1202. It's, there's very specific rules and compliance there under section 1202. But again, like a qualified advisor is going to have no problem doing this. It's not complicated. The US government isn't trying to make that complicated. They're trying to make it as an incentive for people to innovate and to start new businesses and to know that some of that initial value that they're creating, that they can take advantage of tax exemption on that because of the risk that they really took in the early stages.
Why there's nobody telling us this? Like that's the first time when I heard about it.
That's where I say the people that do these a lot and that know about these are very vocal. Like they love this.
Yeah.
Think about it from your advisor's perspective. Like if they get introduced to you later on in your life cycle, as an early company, and if you don't qualify anymore, they're not going to bring it up.
Yeah.
Because what? Like they're just going to hurt your feelings with it, So
you should have done that.
That's what I mean. So it's kind of this really interesting place where you have to be in a position where you're seeing early stage companies really early on. And we're kind of in this unique space where, because a lot of companies like ours are going, hey, we're working with just super big companies late in their life cycle before they're going to go to exit, or ultra high net worth individuals. Those are not like startup founders, right? And so a lot of the people that know are dealing with startup founders. And a lot of the people that are dealing with startup founders don't know, or they're not dealing with that specific part of the startup process. And so, why don't more people know? Hopefully they will soon by watching podcasts like
Love
this.
it.
You know what I mean? Like as we continue to perpetuate and help founders moving into new companies to take advantage of this type of thing, we're just going to be able to create a better ecosystem.
Yeah, so, hopefully. Okay.
And I'm gonna move this into, because that's specifically related to the capital gains taxes relative to your stock as you're growing. Another capital gains strategy that deals with opportunity zone legislation. So opportunity zones, we're actually sort of late in the life cycle of opportunity zone legislation. There's a good chance that the US government will renew this program, but we don't know yet. We'll have to wait until probably 2026 when the program initially expires to see if they're going to renew it.
Okay.
But basically, opportunity zones were set up during the Obama administration and perpetuated during the Trump administration to incentivize investment and development into economically underprivileged geographies in the United States. So basically, there are certain geographies where not a lot of investments being made, and they wanted to incentivize, hey, if you build businesses or you really kind of develop these areas, you can get tax related benefits. Again, a lot of those benefits have kind of gone away, but there's one specifically that we've seen as some interesting creative structure that some investors have taken advantage of. And that is that with opportunity zones, a common situation that comes up. So I'll explain this, and then I'll explain again how some people are utilizing this for their benefit. Yeah. Right. And basically the idea is investment dollars that you put into an opportunity zone fund are going to be tax exempt. Okay, and then, or tax deferred, I should say. You're going to be tax deferred for a certain period of time, and that investment's going to have a certain period of tax deferral. Right? That's one of the advantages of it. So if you were to, have a $10 million capital gain, and you were to put that $10 million into a qualified opportunity zone fund looking for an opportunity zone investment. Let's say you did that late in the year. Let's say you did that late in 2022. So November, December, you have this capital gain event, you sold a business, you sold some property, you have $10 million. You go ahead and put it into a qualified opportunity zone fund looking for opportunity zone investment. That's going to start a deferral process on that gain that you put in there. Well, let's say that then we go into 2023, it's February, it's March, and you just are not finding any opportunity zone projects that you want to invest the dollars in. So you end up pulling the money out of that investment vehicle. You pull it out of the fund, basically. Well, the question that comes up is, So is the gain stay in 2022? Or does the gain move to 2023 because that's when the deferral period's over because you pulled it out of the fund, deciding I'm not going to make this investment?
Yeah.
So in the Opportunity Zone legislation, the way that they outlined it is that the rule that you make is that the gain will exist in the year in which you pulled it out of the fund. So in my previous example, the gain would now exist in 2023. Well, we saw some clients, we saw a client with $300 million of gain in 2022, put some money into an opportunity, put that into an Opportunity Zone, qualified Opportunity Zone fund, looking for Opportunity Zone investments. 2023, the calendar year changed from 2022 to 2023, and they didn't find any investments, and so they ended up pulling the money out, which means that now, instead of because the gain originally happened in 2022, which means they would have had to pay their tax in early 2023 during that tax season. But because of this mechanism, now their gain, they don't have to pay the tax on that until 2024. Now you got 12 months with $300 million. You put that into an investment that earns you 10% yield on that. I mean, that's going to be $30 million of potential additional gain that you can earn off of that money during that 12-month period. While your taxes, until you have to pay your tax. And so just even 12 additional months of deferral, when you look at time value of money and being able to make investments like that can be really powerful for some people. So that's kind of an example of, was that an intended consequence of Opportunity Zone legislation? I don't think so. I don't think that, that the government was thinking, oh, we're going to give the people a way to get a free 12-month deferral out of the process. But it's one of the results of the legislation. And, high net worth individuals have been taking advantage of that during this entire Opportunity Zone legislation period of, you're late in the year, you get a gain, might want to see if you can find some OZ investments, but if you decide that you end up not being able to find any and it moves into the next calendar year, well, you just earned yourself a great 12-month additional deferral on your capital gains taxes.
Are there any authorities that are checking if you are really putting the money into the fund in order to get into that Opportunity Zone?
I think that the hard part about that is, how do you measure someone's intent? Like, what are you going to do? That's why I said it's kind of one of those unintended consequences. It's sort of like, it's in the law. It is the way it is. And, high net worth individuals, they use people that gain from the tax laws the most are just those that understand the rules the best. The rules are the same for everybody, but really the ones that end up getting to take advantage of it the most are those that have the capital to be able to hire teams of advisors that can advise them on the rules of the game and how best to navigate within those rules.
That's why I love to do that, because I know that it's very necessary that more people know about those things.
Absolutely, because I think that when more of us know the rules of the game, then it makes it more fair for everybody to take advantage of those rules.
Exactly.
Yeah,
Right.
I agree. I couldn't agree more.
The only problem with that is, if more people start doing that, authorities will probably look into this.
Look at like conservation easements,
Exactly.
like monetized installment sale. That's why I kind of brought that up at the beginning, right? And here's the thing too, even in that, when you're doing Opportunity Zone investments, if you aren't putting it into an actual qualified Opportunity Zone fund that's filed, that has the right paperwork and filings with that, or if you're not remaining in compliance in the process of looking for qualified Opportunity Zone activities of that nature and that type of thing as well, you can blow it up for yourself or for others, right? And that's why I had mentioned at the beginning as well, the importance of really savvy and ethical and fully compliant advisors in your corner. It's so critical that you have them no matter what you're looking to execute on.
So going a little bit from the strategies into what you just said, how you find those people, how you verify if this is a good advisor or not a good advisor.
That's a great question. I mean, I can only really speak from kind of our experience in the space and situations where we've seen clients get taken advantage of and situations where we've seen clients protect themselves, right? Because you can run into a situation as well, if you're not careful, where if you're just following the bandwagon. You might end up like in a Bernie Madoff situation, right? Everyone was advising, recommending him. They're like, he's the chair of the SEC, or of the NASDAQ, or whatever he was at the time, and and he's getting these returns, and everyone has their money with him. So you can't just follow the bandwagon either, right? But I would say that would be the first place to start, is to talk with other high net worth individuals, friends, those that have sold assets. Who are they working with? What advisors are they working with? Getting feedback from them. What did you like about them? What did you not like about them?
Okay.
That type of thing. So obviously networking well with other investors, other high net worth individuals, other family offices, other individuals of that nature, and organizations of that nature, and find out who they're working with, who are the teams that they sort of have. And then going back to kind of the Bernie Madoff example, we have a client and a close friend that his fund at the time was approached to deploy some capital with Madoff. And he, again, it was this really hot thing. Everyone's like, go with this guy. And he was like, we were blown away that after a couple hours of review of his documentation, we were like, dude, this smells super fishy.
Oh.
And so he was just surprised. He's like, honestly, everyone was seeking advice of who to work with, but they weren't performing any due diligence.
Yeah.
And he was just like, it was so simple. Even just a close look at some of the documents.
Superficial.
Yeah, you would have been able to see that it was that there was some fishy stuff going on here. And so they obviously did not deploy capital with him, which was great. And so that is my point number 2, right? Point number 1, get referrals from other high net worth individuals and those that are going through these similar types of situations. But number 2 is still do your due diligence.
Yeah.
You're going to likely have to sign some mutual non-disclosure agreements with them.
Yeah.
But then that way they might be able to give you some access to who are some of the people that they've worked with before, so that you could call them, get some feedback from them. Ask for some documentation on some of the strategies, some of the legal opinion that they might be, executing based on. Hire a third-party attorney to review some of the documents, just to kind of give you some feedback. If you're going to get serious about, as I think you should, if you care about minimizing legally the amount that you need to pay, which courts forever. I mean, the famous Judge Leonard Hand, right? Basically he was famous for kind of saying like that no one has an ethical, moral, or patriotic duty to pay more taxes than they owe.
Yeah.
And he was a judge at the highest level. Like his whole point was, he was like, listen, it's everyone's right to, like we said, understand the rules and work within them.
Yeah.
And if you can take advantage, then you should. No one has a patriotic or an ethical or a moral right to pay $1 more than they should.
Yeah.
But we should also not be breaking the law, and we shouldn't be avoiding to pay the taxes that we owe.
Yeah.
Right?
Play within the lines.
That's exactly right. And so, but I think that you should be seeking this type of thing, but you should also be protecting yourself by doing your due diligence, getting good referrals, but doing due diligence. And you do that, simply, you're going to be able to find the right partners to start to work with. Absolutely.
Yeah. Okay, we can jump into
cool.
next strategy.
Yeah. So this one we're going to talk about next is going to be another one that you're like, why has no one heard of this? So duty drawbacks. What's interesting about this is a tax, but it's not part of the IRS tax code. This is part of Customs and Border Protection tax code, a different department within the government. Eventually the money all funnels down to the Treasury, right? But this is a completely separate organization within the government that handles this type of tax, which is duties. And those are going to be like import taxes. So when companies are importing a lot of goods and services from overseas, there's going to be what are called duties on the types of things you import, and different types of things you import. So metal or sugar or wood or finished goods like toys or whatever from China. Each of these things is going to have a different amount of tax depending on treaties that the governments have amongst themselves, right? A tax on sugar, for example, might be a lot less than a tax on petroleum or on aluminum, for example. But companies that import a lot and pay these taxes, these duties, which all of us pay by virtue of the fact that those duties trickle into the cost of goods that ultimately get passed on to the consumer when we buy. If you also have a lot of exports, which is something the government wants to incentivize, they want us to be an exporting nation, selling our goods, services, technology to the rest of the world, right?
Yeah.
That's good for our GDP. So if you have a lot of imports and you have a lot of exports, and you can show a chain of custody between the stuff you import and how it gets transformed into a finished good and then exported, you can offset those imports with your exports and get a refund on the taxes that you pay, the duties that you pay. If you're an exporter, you're doing a lot of export, it doesn't even have to 100% be your imports that you can use as an offset. For example, if you are a candy manufacturer and you're exporting a lot of candy to the rest of the world, and you're not personally importing the sugar, but you're buying it from a supplier that's importing it from Brazil, for example, right? Then there's inherent in the cost you paid for that sugar is some of the duties, because they market it up as their cost of goods to you to buy, that you now turn that sugar into candy. So there's a formula you can apply to get some of that, those duties back on the sugar that you paid for from the guy that imported it.
Wow.
And that can give you a refund check as well.
Insane.
And this is cash refunds from Customs Border Protection, cash into your business. You know, for us, the largest one that we've dealt with personally right at this point, you know, is about $20 million refund to a business.
Nice.
Pretty fantastic, pretty phenomenal. But we have a friend company, so, you know, a company that also does duty drawbacks that's, you know, friendly with us, and we get along well, work strategically together. They just closed a client that everyone would know their name. I can't say their name, but everyone would know the name of this business that they just closed with, and that business is going to be able to get about $100 million back annually.
Wow. So it's recurring. It's not like one time.
Well, because as long as you're exporting,
yeah,
as long as there's imports and there's exports, and that's happening, this is something you can do every year. In fact, if you do it well, which everyone should, but again, some people work with bad advisors, so they do it poorly. But if you do it well and you're accurate in your assessments and it's filed correctly and everything's great, then eventually Customs and Border lets you make estimates quarterly. So they basically let you just go, like, based on all of my previous imports and exports, about every quarter, it's this. You still have to report on it, but you basically, instead of waiting for a refund check, you just don't have to pay the duties at all. You basically just get to go, hey, for this quarter, we typically, you know, have about this much of refund that we have historically gotten, so we're just gonna not pay the tax.
Yeah.
And they're cool with that, because for them, it's like, they don't want to have to go through all the administration work, you know, for somebody that is claiming these regularly.
How long do you have to do that to reach that point?
It depends. Typically, I mean, for a lot of companies, it can happen within the first year. So like you know, you're gonna have to go through a full year of being compliant.
Yeah.
And then like the next year, you can start to get into that. Again, it depends a little bit on like how many errors were in your documentation, you know, and again, if you're working with someone good, then you're not gonna have any errors. But people that try and DIY this, you know, themselves or whatever, they're typically going to have a lot of errors. And if you do, then, you know, Customs and Border doesn't give you that privilege.
Yeah.
But we've seen companies as little as 1 year into it. They in compliance for a year, and then after that, they can start taking the estimates. It's
so
great.
you could actually use it in any company that is buying products and creating something new and exporting
As
it,
long as they're
right?
exporting it, yes.
Yeah.
And like I said before, even if you're an exporter, you should still be looking at this, even if you're not importing.
Yeah, exactly.
Because there are ways, obviously, what you're putting together, there touches some import that happened at some point.
Yeah, for sure.
Right? So if you're a big exporter, you should absolutely be looking at this.
Wow.
If you're an importer, you should be looking at it, even if you're not exporting, because there's a good chance that a company like ours or others could connect you with an exporter that you're dealing with in that supply chain, and that there's opportunity there as well. So there's different ways to pull this off, and it can and again, it's built into the code because the government's trying to incentivize exporting. They want to make the economics of that better for the companies that are doing it.
Yeah.
Right? The more money that those exporting companies have to continue to build, create, and innovate, that's going to be more jobs, that's going to be more innovation, that's going to be larger scale businesses that can hopefully export more.
Yeah.
The government is trying to help its people build, create, and innovate.
Yeah.
Right? And that's a lot of what tax code is built around, is how to provide the right incentives to the right people. But to our point earlier, sometimes it's just that you just don't know. Because I mean, there's 70,000 pages of tax code, and your CPA's job, like we said in the beginning, is not to read all 70,000 pages and advise you on strategy.
Yeah.
They have thousands of clients. They're handling the accounting parts of that process, and you shouldn't beat them up because they didn't bring up strategy to you. It's just not their job.
Yeah.
But you should find some people whose job it is to read all of the code and to understand where are the opportunities within it. Cool. Should we keep going?
The next one, yes,
Okay.
I love it.
So we're gonna pivot slightly over to tax credits.
Okay.
We'll come back to some strategic stuff.
Okay.
But credits are built into the tax code, like we're talking about, to incentivize certain activity. And a credit, for those that aren't familiar, is like an IRS gift card. Okay, so basically,
we love gift cards.
We love gift cards, and it's like the IRS gives you a gift card. It says you can pay your tax. You know, when you go to a restaurant with a gift card, you're going to pay for your meal with the gift card. Well, with an IRS gift card of credits, you can pay for your taxes with a credit.
Yeah.
It's a dollar for dollar reduction of your tax bill. Okay, so where a deduction, an expense is going to be, you're going to take your gross income minus your expenses to get to your net income, and then that's how you calculate your tax bill.
Yeah.
A credit is going to be an offset of that final bottom line number. You have your tax bill now, and if you have a final tax bill of $100,000 and you have $100,000 of tax credits, now your bill is $0. You owe nothing. The most popular credit that probably everyone that's going to be watching this today has heard about is going to be the ERC, the Employee Retention Credit. And this came out with the CARES Act during the pandemic. ERC and PPP came out at the same time in the CARES Act. The PPP was you could get these loans that were forgivable loans for your business. Well, because that was so popular, most people didn't learn about the other part of the CARES Act, which was the ERC, the Employee Retention Credit. It's only become popular within the last year or so, or last couple of years, because originally it was you could take PPP or ERC. But then they came out later and said, okay, you can do both. If you claimed PPP, you can also claim ERC.
Okay.
You can't get this, not with the same dollar. If they already gave you some money, like you have to take a deduction on that. But the point is, it made it so more people became eligible. And that credit was really, if you had kept your employees during the pandemic, not let them go, you were eligible to get a certain amount of cash back. It's a credit.
I think I heard of it.
Yeah, most people have heard about that. And so I'm not going to dive into the details of that because most people have heard about that, but that's an example of a credit. The one I'm going to talk about a little bit more specifically is the Research and Development Tax Credit. This is a very powerful, very accessible credit for most businesses. And I think the last statistic that I read was only about a third of companies that qualify actually claim these credits. So there's a lot of money on the table that the government wants to give businesses that are engaging in R&D activities, in research and development activities. And the reason why most people don't claim these is because you think research and development, you think lab coat, beakers,
doctors,
whatever, right? And that's just not, do those activities qualify? Absolutely they do, but there's other activities that also are considered research and development. Really, any sort of business activity that kind of deals with different life sciences. So like beakers and those types of sciences, that kind of R&D activity, but also like technology or like engineering or, other types of, architecture, that's an example.
Or like innovation within your industry.
Yes, like exactly. Even like systems and processes innovation, some of that can qualify. It's a credit on the amount of, the primary way you claim it is against the labor for those qualified activities. So like the amount of innovation, the amount of engineering, the amount of technology development within a business, or the implementation of certain technology within a business, the people that are involved in that and their wages, you can take a certain percentage. Most states have a research and development tax credit, and then there's federal one.
Mm-hmm.
So between federal and state, you're going to be getting anywhere between 10 to maybe 15 cents on the dollar of all of that spending on that employee time. So,
Nice.
if you have a payroll of $10 million of qualified research and development activity, then you could be eligible to get $1 million to $1.5 million of tax credits back every single year that you have that spending. And if you have never claimed a research and development tax credit before, you can go back 3 years and claim on the taxes you've already paid. So for companies in that situation, they might have $4 million of refund. So that's not just like a credit on, that you can use to offset future taxes. That's actually like a refund check coming to you. $4 million, here you go.
Just
right? And this is going to be eligible for businesses of all sizes, right? So you're out there listening, you have a small business, you got $1 million of revenue. There's a good chance you have some R&D activity within there that could qualify. And a business that's doing 100 million a year or $1 billion a year. They're also there's no like limit, right?
Okay.
You can be small, you can be big, and it's really just going to come down to how much qualified activity do you have, and how much of that can you reasonably claim and build a defense around.
But it's only about the employees that are working, the payroll we pay.
It's not only that. That's probably the primary and biggest way to grow your credit. But other expenses that were relative to claiming the credit, or to the R&D activity. So, for example, let's say that there's a company that I'm saying let's say, but I'm pulling this from like a real life example. So so they what a wench is?
I have no idea.
Okay, so like a wench, what most people are familiar with a wench would be like on the front of like a Jeep. It's like the thing that like has like all of the cabling on it, so that like, you can pull like a hook out. And so if you're on a Jeep and you get stuck in the mud, you can pull the hook out, wrap it around a tree, and then use your wench to like pull you out. So like really large boats often have wenches on them too. So whether it be like a cruise ship or a large shipping vessel or whatever, okay? There's a company that makes these wenches, and like that's their product. They're selling that, right? And typically when you are selling a product, it's coming off a manufacturing line. There's no R&D on the actual like product creation at that point in its life when you're manufacturing it, because it's like all the design work's already been done, the R&D work's been done, and now you're just pressing a button like make a unit, make a unit, make a unit. That's not R&D at that point, right? All the stuff that happened before that's R&D, but once you're now like just stamping them out, that's not R&D. Gotcha. But for this wench manufacturer, like almost every single one they would make would be kind of custom.
Different.
Because like each boat's a little different, where it needed to go, like the specific specs, like all that kind of stuff. So that means like even their product that they're selling, they could claim the raw materials, the labor that went into the manufacturing, all of that, because there's uncertainty in every single one that they're making. So all of that could be claimed as research and development activity. And so not only can they claim the labor of their business, but they can claim all of the cost of goods. They can claim all the raw materials. They can claim like the shipping and logistics and some of that other kind of stuff, right? Like there's different components depending on how those contracts are set up and whatever. I mean, again, like I said in the beginning, we're not getting into every nitty-gritty detail. Talk to your advisor, okay? But the point is that a lot of that kind of stuff can qualify.
So let's say I'm building a factory.
Yeah.
Could I deduct all the expenses to build the factory, which will help me to run my R&D development activities?
Good question. So it depends. For example, if you're going to build a factory, are you going to employ the engineers and the architects that are going to put the plans together for the factory, or are you outsourcing that? Because if you're outsourcing it to another company that's doing the engineering and architecture work, that company might be the one that's claiming the credit, depending on your contract with them. Because you can claim the expenses of companies that you contract with if your contract with them is set up in a specific way. And it really comes down to where is the risk. Meaning, if you hire an engineering firm or an architecture firm to build this to put the plans together for this factory, and your deal with them is that you are going to pay them hourly. So like, you're going to bill me hourly for as long as it takes to come up with these plans. Well, then the risk is really on you, because it could cost $10,000 or it could cost $100,000 or it could cost $1 million. And like, you have to assume the risk of that, of those research and development expenses. But like, if instead your contract with them was, I'm going to pay you a flat $100,000 to get me these plans, and if you spend more than $100,000 putting them together, not my problem.
Yeah.
That means the risk of the research and development activity is really on the engineering firm. So they get to claim the credit, not you.
Okay.
Right?
Even if the building is like regular, normal buildings, but the activity of R&D is like happening inside,
then the building itself probably is not eligible, but the activity would be. But, I think that you bring up a good point too, like back to like engineering, because it's a typical building. Well, let's say that you're talking with an engineering firm that builds bridges, or that comes up with the engineering for bridges, and they do it all the time. It's like, well, what do you, like, there's no uncertainty in their business anymore. So how can those be R&D activities? Because like, they put the engineering for bridges together all the time, and they always know that they can do it. It's like, their activity still qualifies because even though they know they have the expertise to do it, and they've proven they can do it multiple times, there's always uncertainty in every specific project, like the geography of where the bridge is going to go, and what's the land and the silt and all that kind of stuff. Like, all that uncertainty is what makes it R&D. It's when the uncertainty is removed, in that if you just bought the plans to a building off the shelf, do you know what I mean? No uncertainty there. You just put this here, you assemble it like this, there you go, right? Or like I said with the factory situation before, once you've built the machinery and equipment so that you press a button and it spits out a widget, make iPhone. It's like, pss, 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 and it just shoots it out the door. That now is when the R&D's over. Now it's like in production. There's the uncertainty's over. It's just stamping it out. But what I would say for your audience is, even if you're listening to this and you don't think you have R&D activity in your business, ask yourself the question, are there aspects to your business in the development of your services, your products, where there's uncertainty?
So services qualify to that as well?
Again, engineering would be like a service, or an architecture would be like a service.
So building a code?
Building code, building software development activities, absolutely, that would be like a service, right? Yeah. And so, yes, like those types of activities can absolutely qualify. So the question is there uncertainty in what you're doing? And if there is, contact an advisor and talk with them about.
What about a nail lady that is painting nails? There's always uncertainty that she's making.
She should absolutely connect with a qualified advisor to explore her situation. And that's the thing. Every single situation is unique. It's impossible to right now describe every single does not. But that's why I just say, work with a qualified advisor. Work with somebody that's expert. Your CPA can get you these likely, but they're probably going to underclaim because they're probably not going to build a complex study, legal defense for you. And so, and don't give them a hard time about that. Likely be cool with the fact if they want to refer it to an R&D tax credit expert. Yeah. Right?
It's always better.
It's always better, again, your primary care physician, be cool with the fact they're sending your referral to a heart surgeon. Don't be like, why do you suck so bad at medical that you can't do my heart surgery? It's like, no, dude, like, of course, they're just different. Be cool with the fact your CPA is likely going to be like, that's a great idea. Let's refer it out to a specialist.
Yeah.
Right? And that's fantastic. Or if you're listening to this, seek out an R&D tax credit specialist, someone that's really good at that. And they'll likely be able to get you more because they're going to be able to build a better legal defense for you.
Yeah,
so,
for sure.
This next one's kind of fun. We lovingly internally call it our art of taxes, but the thing I want to make sure I'm pointing out, this is not special and unique to us, Anyone on the planet can do this. Again, there's nothing. We don't have any secret sauce, right? Anyone that's that's listening to this, anybody can go and do this. This is as old as charitable donations being in the tax code, which is like from the beginning.
Yeah.
Okay. From the beginning of time, high net worth individuals and those that are savvy with the code and understanding charitable giving have been able to take advantage of the tax benefits of charitable giving. I'm going to describe a way that you can put this together, and anyone can find the type of material I'm going to talk about. I mean, the best place to look for it is going to be like estate sales. So going like when someone's passed away and they've got, they're selling assets out of their estate, and sometimes they're going to have art or historical records and documents, or they're going to have sculptures or statues or things of that nature. Any of those types of things might be a good fit for what I'm describing. You can donate not just cash, but you can donate capital assets, property, to qualified 501c3 nonprofit organizations, and you can get a tax benefit for those donations. Conceptually, there's this idea of an equity differential. That's what we would call it. And that would be the difference between what you can pay for something versus what you can donate it for. Because when you are going to donate an item, it's the donation value that determines the tax benefit, not what you paid necessarily, but there's rules around this. In theory, you could go to an estate sale, you could buy a piece of art off the wall and they don't know what they have and they sell it to you for $50. And I'm going to outline the rules, the basic rules for compliance. Again, work with your advisor. But I will outline briefly in just a moment the basic rules for compliance. But let's say you bought that piece of art off the wall for $50. You send it off to a qualified third-party appraiser. Comes back that they say, this thing's worth $1 million. And you want to donate that to charity for $1 million. Well, you can get a tax benefit at $1 million value, even though you only bought it for $50. Tax benefit on $1 million value. Let's say that's 300 grand, 350 grand. You could eliminate $350,000 of taxes and you paid $50 to do it, right? And so
does that ever happen?
It happens all the time.
Wow.
It happens all the time, especially among high net worth, ultra high net worth individuals. This is very popular. This happens all the time. Yeah, and not just with our business. This happens all the time.
So you have a lot of clients that actually did that.
Oh yeah, we do this all the time.
Okay.
Yeah, so let me go through some of the pieces of compliance, and then I'll talk a little bit about some of the infrastructure we've built to make this more accessible.
Love that.
But like I said, anyone can do this. This is not unique to us, right? Some of the parts of compliance that are really important with this is, like I said, getting a qualified third-party appraiser, getting somebody that is expert in the field in which of the type of item that you have. And you want to look for an appraiser that has hopefully decades of experience at minimum, and that has no negative reversals or adjustments. Okay, so that their appraisals have not been called into question or negatively reversed or adjusted, right? That's what you're targeting and looking for in an appraiser. So if you bought a piece of art from an estate sale, find an appraiser that's expert in that type of art that you bought. Second thing is, when you're going to do this, you're going to want to donate, again, like I said, to a qualified 501c3. So that's going to be a qualified nonprofit. And you need to make sure that the nonprofit, that what you're going to donate to them is part of the charter by which they've been set up. So not all nonprofits are created exactly equal. For example, the Red Cross is a nonprofit, but they're going to have a different type of charter than a university is. That also could be a nonprofit. And a hospital could be a nonprofit. They're going to have a different type of charter than the university, for example. When you're setting up a nonprofit, you have to kind of say, what's your mission? What are you trying to perpetuate and do? And so if you were to try and donate art, the Red Cross would not be a great place to donate that.
Yeah.
Versus a university or a museum would be, because art is part of the charter of their existence as a nonprofit, okay? You also need to make sure that the item that you're donating, if you want its appraised value, you need to hold the item for longer than a year. When you hold an asset for over a year, it becomes, according to the tax code, it kind of transforms into a long-term capital asset, okay? And long-term capital assets are going to be able to take advantage of the appraised value of an item. A short-term asset, meaning if you went to that estate sale, you bought the item, that you bought the piece of art for $50 and you donate it tomorrow for $50, and you donate it tomorrow, then it's short term. You haven't held it for longer than a year. And the rules on that is you can get what you paid for it. So you basically attach your receipt. You say, I paid $50, I want $50.
Yeah.
So if you want the million though, after the appraiser comes back to you with saying, oh, this piece of art's actually worth $1 million. Well, you need to wait for 1 year to make it so that the item becomes a long-term capital item, meaning it now is eligible for the appraised value. Okay?
Quick break.
Please.
How do you recognize what art or what things that you are buying for $50 are actually going to be worth $1 million?
That is the trick. There's really no exact science on how to, people that are more expert in art, that have more experience in art, are going to be better qualified than just someone off the street to do that, right?
Yeah.
I mean, for example, if you were an expert in a Picasso, for example, if you were a Picasso expert, you just had a passion for Picasso, and you were in the estate sale and you see this really obscure Picasso, everyone else might be walking by because they're like ugly, and you might be like, this is Picasso. You know what I mean? But yeah, everyone else might walk by because they might not know, right? So what ultra high net worths do, if they're not expert in this type of thing, is they're typically going to find the people that are, which means they're going to be having a lot of friends, the art world, or in the historical record world, or that type of thing, so people that can help source for them items. And that's one of the reasons why this is really accessible to the ultra high net worths of the world and not as accessible to everyone else, is because there's this expertise gap. That's what we've at our firm have tried to close that gap by making this more accessible, by us building the infrastructure. We've built the relationships and friends with the art galleries, with the ancient and historical document record, individuals, with the individuals that have expertise in ancient, religious relics and those types of things. We have a really large network that are constantly looking for items on our behalf that we can sell to our clients. So our clients can come to us, they can be interested in what I'm talking about right now. We can help connect items to them, basically, that we've helped find through our infrastructure and our network, and they can take advantage of that. And so, and again, there's likely others that are doing that as well. I'm not super familiar with a lot of people that have built the type of infrastructure we've built. But like I said, this also isn't unique to us. What is unique to us is the infrastructure that we've put together to make this accessible to more clients. But the strategy itself is accessible to everybody.
Okay.
So, yeah.
Is there any rule that you need to comply with?
And so, in addition to some of the rules I already mentioned, you need to make sure when you're donating to a charity that you're not getting any other kind of benefit for that donation. Meaning, like, you can't donate the item to the university and have that help your kid get into the university and remain eligible for this tax benefit. Right? Not only are you probably breaking other ethics laws as well, but you can't like donate something to charity and have them like give you access to like the president's club of the university, for example.
Yeah.
Like any kind of like exchange of value makes you ineligible for the tax benefit. Like you need to donate it without getting any kind of other benefit, and then you can be eligible for the tax benefit. And like that language has to be built into your contract with them. Like, I am specifically not getting any benefit. And I'm serious, there's like a paragraph you have to put in the contract. There was actually a case, this is an example of the fact lots of people do this, right? There was a court case recently from an individual on the East Coast that was working with somebody else. They were doing the strategy and they did not have this paragraph in their contract. So it went before a judge at court, and he's reviewing it and he's reviewing the rules. He's like, listen, I get that you were trying to do this in good faith. I get that you were trying to remain in compliance, but you are missing this rule as part of the law.
Yeah.
And so we're going to have to reverse your benefit. So like that's why you got to work with advisors that are good at this stuff. You got to like find qualified advisors that are good at this stuff, and to protect you on that. And then, like I said, you need to make sure that you're holding the item for a year. And this can only offset 30% of your AGI. So AGI, for those that don't know, is adjusted gross income. So if you have $1 million of income, then only 30% or $300,000 of that income would be eligible for this type of charitable donation to get a tax benefit.
Okay.
right? There's no limit. So, we work, for example, with clients that are making $300,000 a year in income to those that are making, we have transactions that have been $80 million in a year transactions. There's no limit. It's just only 30% of that adjusted gross income is eligible for this type of charitable giving offset.
Anything else about this strategy?
No, I think that's probably a pretty good overview to kind of go through that, but that one's kind of a fun one that a lot of people,
I really like that.
I guess the next time that you see, billionaire donates X thing to charity, now you'll have a little insight on, they're probably like getting a benefit greater than, a tax benefit that exceeds what value what they paid for that. I'm gonna talk about a couple additional things. One is a little deviation on what we've kind of been talking about so far, but we set up a law firm a couple of years ago. Well, it's been about 18 months ago now at this point, under the Utah Sandbox. Anyone could go look that up, the Utah Office of Legal Innovation, but specifically for the purpose of working with cryptocurrency tax issues, legal issues. Cryptocurrency has been, as much as people have expected that it would go away, it just continues to grow. And it's kind of come to a place where it's unavoidable to see it as part of the finance system in which we live at this point. And, based on its growth, even though there's legislation that's currently on the floor of the House and the Senate, in trying to pass specific law and specific tax law, specific compliance law for the SEC, all kinds of things on how to handle cryptocurrency. None of that has happened yet.
Mm-hmm.
And so the IRS came out with guidance years ago in lieu of there not being formal passed cryptocurrency legislation on how to treat cryptocurrency from a tax perspective. Here's our guidance on how, if you're a CPA filing for this stuff, how to treat cryptocurrency in the short term. Like until there's legislation, here's how we recommend that you do that. The IRS can't pass law, so guidance is not law.
Mm-hmm.
Okay, just because it's published on irs.gov does not make it law, right? There is tax law, and then there's their guidance. Or, recently they came out with a revenue ruling. A revenue ruling from the IRS is not law. This is their feedback, their guidance, their suggestion, but it's not law, okay? The legislative branch of the government is the only branch of our government, because we are governed by a rule of law, that can pass laws. And I just want to make sure that's clear to everybody, because it kind of helps explain some of what we're doing. But, that guidance the IRS passed, we feel that some of that guidance is inconsistent with the current existing law. And so, there's positions relative to the mining of cryptocurrency, like Bitcoin, for example, or staking. So the rewards that you earn from staking activities. Staking is, and again, there's not a direct one-to-one comparison, but staking, most similarly to those listening that aren't familiar with cryptocurrency, that would be like earning interest on money that you put into a savings account or a bank account. Mm-hmm. It's like when you put your money into a savings account, you're staking it into that account so that the bank can use that money to issue loans, and they pay you some interest. That's kind of similar to what's happening with staking, a little different, but it's like as most closely for those that are listening. Again, a little different. It's actually probably more like you have stock, because the IRS calls cryptocurrency property. And the example I just said is what you would how you'd handle currency. So it's actually probably more like stock and being issued additional stock, but that's why I'm not trying to be too complex. But like staking rewards, wrapping of coins, which is a whole different type of technology. Anyway, there's all these types of things where the IRS is kind of giving some guidance, and in our legal opinion, through our law firm, feel like that there are positions and legal defenses that individuals trading cryptocurrency could take to not pay tax that otherwise by guidance is said you should pay it this way, but because we think the actual published law, we think that you should be treating it differently than how the IRS has provided guidance. So we actually write legal opinion, and we help defend clients in cryptocurrency that are trading cryptocurrency, and institutions that are trading it, enterprises that are trading it and dealing with it. We actually advise and provide legal opinion and legal defense through one of our other partner law firms for those that are in the cryptocurrency space, because there's kind of this flux in the law. And so that gets really interesting. We have clients that have taken legal positions and have bought legal opinions that their whole investment might be $50,000 in legal opinion, legal defense, and that can eliminate. I mean, we have examples where that's eliminated $4 or $5 million of tax.
So you actually had some success stories.
Oh yes, absolutely,
give
all
me
the
some.
time. Yeah. I mean, that's one. Like we work with a lot of executives of some of the top companies in the cryptocurrency space, top SaaS products of cryptocurrency. We have a sister firm called Moontax that handles reconciliation services so we can track cost basis and help create a chain of custody of cryptocurrency. We develop technology internally as well, based on our learnings from this. But yeah, I mean, we have lots of clients. We have high velocity traders, those that are 5,000, 10,000 transactions a year. We have clients that we've saved as little as their tax bill might have been a couple $100,000, and we've helped them eliminate that. We have those that are have a $10 million tax bill that we've been able to help them. And when I say eliminate, I mean like in the short run. Typically with this, it just means you're going to owe tax someday. You just don't owe it today. And this is a situation where it's like, hey, the IRS is telling you that it's taxable now, and we're saying, well, it probably should only be taxed when you actually sell the asset, for example.
Okay, so it's not a complete elimination.
It's not a complete elimination. It's that as long as it remains in this state, it shouldn't be taxable. And when you transform the state that it's in, that's when the tax should be owed, not today.
Okay, but we are talking about this specific strategy because for the R&D, you eliminate the tax.
That's where you're getting a credit and it's completely eliminating the tax.
Okay.
This is going to be, in some instances, it might be like, this isn't taxable and it should never be. But there's also going to be instances where it's like, this shouldn't be taxable now. Like with the case of mining Bitcoin, for example. Our position is that you shouldn't be taxed on Bitcoin when it's mined. You should be taxed when it's sold. Every other asset that's like that in the entire world, where you have a piece of property, think about like when you plant an apple tree and it starts getting apples and you go pick an apple off the tree, you don't owe tax on the apple the moment you picked it. You owe tax if you take the apple and you sell it. When you're building a house and you put the last shingle on the house, you don't owe tax now that the house has been finished on construction. You owe tax when it's sold.
Yeah.
When you, just like Bitcoin mining, when you go mine gold out of the earth, you go find some gold in the earth, you mine it with a pickaxe, you got this nugget of gold, you don't owe tax now that you have this nugget of gold. You owe it when you sell that. For some reason, Bitcoin, that's currently classified as property, you can't expense the blockchain, which is normally when you're taxed on receipt of something, it's because there's been this value exchange where you can expense the individual that that made the payment. The blockchain, it's more like the tree. You can't expense the tree can't take the expense of the apple. The earth can't take the expense of the piece of gold. You basically, like, the blockchain's can't take an expense on that Bitcoin. It's just created. And so anyway, we that's like an example of like a legal defense that we perform, and that we write legal opinion for. So the thing I think I want to leave the audience with that is ultra high net worths, high net worths, large enterprises, large businesses, legal opinions. These would be the types of things that large firms like Covington and Burley, McDermott, Will and Emery, some of these really large legal tax firms, they write legal opinion all the time. And that's for like situations that are sort of a little gray, and where they're going to perform in-depth legal analysis to provide opinion to high net worth individuals that are going through transactions. So this happens at like the super highest levels of finance. And I think I just want to make sure that your audience knows, no matter what size they're at, legal opinions and the firms that write them, it's good to be aligned with a legal tax firm, I guess, because if you're going to be dealing with different tax issues and you're going to be going through complex business transactions or trading cryptocurrency or whatever it may be, it's good to have a firm that's expert in legal tax in your corner to help advise you and potentially write legal opinion for you. Because if you make decisions on your taxes when you have a legal opinion from a law firm, it helps you avoid penalties. if there's reversals. It helps you in the defense of that type of thing, because you get to go, hey, I just did this thing because I was advised to do it by someone that's expert. I didn't know. It helps defer the blame and the consequences away from you.
Yeah.
So, as those listening, when you're looking to make complex tax situations, it can be a smart idea to get a legal opinion on what you're doing, because that can help you get the benefits of what you're doing, but also make sure that you're minimizing your risks. So I think the final area I want to kind of just advise the audience on is also to have a really good estate plan, to work with some really good estate planning advisors, great estate planning attorneys. And again, to build your team, going back to the beginning, don't expect your CPA to do all this for you. Please do not. Not because they're not smart, not because they're not the best. We love our CPA partners.
Yeah.
I'm trying to help defend them right now. You should not expect them to do all of this for you. You should have them. You should have a tax strategist, like a firm like ours or something. But there's plenty of others that they don't have to work with us. Tax attorney. You should have an estate planning attorney.
That's a lot of attorneys.
I know. And it's not cheap, but I'm telling you, if you're in a place where you're building business, you're building enterprise, you're building value, and your wealth is increasing, these are worth the expenses because they will save you a lot. They'll save you a lot. They'll be the type of people that'll tell you about the in the beginning, 1202. Oh, hey, let's get you a 1202 filing. That's gonna be $10 million that you're gonna be able to earn tax-free. That's huge.
Yeah.
And that's like just for having a good advisor in your background, in your back pocket. You're gonna save way more than you spend by having good advisors, really good advisors. So, but with estate planning is the same way. I mean, the most popular example of like an estate plan benefit that everyone should go Google this. There's a lot of people that are going to be on the internet like hating what I'm going to describe right now, but it doesn't change the fact that it's free, that it's legal and that it happened. Okay. Peter Thiel, though, he was one of the original founders of PayPal. He was the first investor in Facebook. He put the first $500,000 in Facebook. He is notorious for having this $5 billion plus Roth IRA account, right? And it's like, how the heck do you get $5 billion into a Roth IRA? Most people are familiar that with an IRA, which is a retirement investment vehicle that the government has created. Yeah. A Roth is a different version of that same retirement investment vehicle. There's contribution limits. You can only put $6,500 a year, or $6,500 a year into an IRA, into a Roth account. So there's limits on the amounts of contributions that you can make into those accounts, and there's income limits and contributions. Like if you make too much income, like you're limited in some of the access that you have to some of these tools. So it's like, how the heck did you get $5 billion into a Roth? And it's by making early contributions of equity. So basically, if I was to start a business today, let's say I start a C Corp today. We already went over 1202, and that's a great program. But let's say I start a business today. What's the value of my equity in the business? I own 100% of the equity, but what's its value? It's probably worth nothing. Yeah. Well, that means that I could put all of the equity of that business into a Roth. And again, you want to talk to your advisor. I'm making a very simplified example. You can't do it exactly the way that I'm describing. I'm trying to simplify it for the audience. But the point is, you can put equity into a Roth that avoids the contribution limits because its value is nothing. Yeah. You're not hitting the $6,500 value, contribution value. What if you do that? So now 100% of the equity is inside of the Roth, and then the value of that equity goes from 0 to $1 billion. That happened within the Roth structure. That happened after avoiding the contribution limit. So all of that growth gets to happen within your Roth and gets to be accessible to you tax-free when you move into retirement age, 65, 67. Wow. Right? So that's what Peter Thiel did. He put lots of equity in the investments that he was making when they were worth nothing and very small, put equity of those investments into his Roth, invested within the Roth structure into early equity investments, because you can have money in your Roth and you can make investments with that money into buying equity, all within the Roth, and then saw the value of that equity substantially grow, right? Facebook stock, PayPal stock, he's, one of the most prolific and exceptional, technology investors on the planet. But he was smart about estate planning, about putting these assets and structures into retirement vehicles that are totally blessed and built by our government for the benefit of people in retirement. And that's why when you go on the internet, everyone's going to be like, this is the gross abuse of the retirement planning system. No one should, was never intended to have $5 billion in a Roth. It doesn't make it illegal.
Yeah.
He played within the rules. He took advantage of that. Nancy Pelosi, who, Speaker of the House forever, she's got a massive Roth, billions of dollars in her Roth.
Wow.
So it's not just the ultra billionaires, it's also the politicians taking advantage of this too, right?
Do you take advantage of that as well?
Absolutely, I have a Roth. Everyone should have a Roth IRA account. If you don't have a good estate planning and retirement planning attorney and team in your back pocket, you need to go get one. Because these are individuals that can help you when you're buying assets, when you're selling assets, when you're structuring your assets, to do it within certain structures that are totally legal and that will help you as the value of those things grow. One, to be able to take advantage of the tax benefits of that, but also for your safety and preservation too. Estate planning structures, we're not just talking about tax benefits at that point. We're talking about the fact that every executive, any business owner, any investor should be putting a massive amount of emphasis on their estate plan, because one investment can go bad, or an investment that you're in, maybe the company, let's say it's a food company and they end up poisoning a bunch of people, or a liability issue happens with someone's product or whatever. Well, the way our current court system works, you can bring all kinds of people into a lawsuit. Maybe you bring in the executives from the company, maybe you bring in the investors, maybe you bring in all kinds of people to try and recoup damages. Yeah. Well, if you have a great estate plan, you've got your assets protected within a trust, well, that makes them very, very difficult to penetrate and to touch when you're in some sort of legal proceeding, right? It separates those assets from you so that they can't be drawn in to have to pay damages on certain things. You could do nothing wrong and still get drawn into a legal case where you're going to get sued and someone's going to try and come after your assets personally. And you should have them preserved within a trust. Put them within a solid estate plan with solid trust structure. So not only are you going to preserve and protect your assets and make them accessible to your heirs in the future to hopefully be able to take advantage of some of the laws on ways to avoid estate taxes, gift taxes to your family when you die, things of that nature. But you'll also, in addition to preserving it, you'll also be able to take advantage of great tax related benefits like Peter Thiel did with his Roth IRA, So putting life insurance into trusts, putting life insurance into estate plan structures so that when you die, your death benefit can go within that structure, tax-free for your family. Again, taking advantage of retirement accounts, putting your equity into retirement accounts, buying equity within retirement accounts. These are all really, really smart things to do. And your estate attorneys, your really solid estate planning advisors, they can give you all the advice you need on how to pull this off.
Wow, I want to talk to you more about that. Seriously.
Everyone should be doing this. In my opinion, everyone on the planet should have an LLC.
Yeah.
They should have a solid estate plan. They should be contributing to their retirement accounts. And they should be investing through those retirement accounts. I'm just kind of that to me is living in this world we live in 101.
Yeah.
It's finance 101. You should do that at a minimum and have good people in your corner. And you're just going to be able to take advantage of the game and the rules, the best possible way.
Oh, yeah, totally. It's insane how many things you can do within the retirement account.
Yes.
Here in the US.
It's incredible.
It's insane.
It's absolutely incredible. Yep, retirement planning and that's the thing. People are going, I'm not going to worry about investing until I'm 65. When I retire, that's when I'll be an investor. It's bro, you got to start thinking about that today.
Yeah, oh yeah.
Right? If you want to take advantage, start today. Start in your 20s. People should be contributing into their Roths in their 20s.
Yeah,
and
totally.
time value of money, that's when it's really going to work in your benefit. Don't start in your 40s, don't start in your 50s, definitely don't start in your 60s. But if you haven't started, then start today.
Yeah, totally.
Right?
Totally.
So, everyone's objectives are different, everyone's structures are different, everyone's income versus capital gain situation versus the state you live in, it's all different.
Yeah.
And so really, we obviously would love to talk to anyone that wants to talk about this or anything else, right? But lots of good advisors, if you come back to my original point, expand on your CPA, go get some great tax advisors, and don't say that your CPA sucks. Your CPA is great. You just also need some good tax strategists, get some estate planning in your back pocket, get some great attorneys in your back pocket, and start to explain to them as a team what goals and objectives you have, and let them start to put the pieces together for you relative to your situation and your goals.
Mm-hmm.
There's really no one size fits all for anybody. There's no silver bullet. All of these things I mentioned are good in different circumstances, different situations. And so it's really about having a team that can work together in understanding your objectives and then going and getting it done.
So how people can contact you, where you are located, give them your website, phone number, I don't know, whatever.
We are a national firm. Our headquarters is in Salt Lake City, Utah, but we have offices in Dallas and Chicago and in Florida, Denver. We do a ton of work out of New York and out of California, Scottsdale, Arizona. We've got representation down there. We do have a team that's around the country, but I think the best way, if someone wanted to connect up with us, they could go to our website, so www.b10cap.com, so the letter B, 10, CAP, b10cap.com. I'm on LinkedIn, a lot of my team members are on LinkedIn. You can search for B10 Capital on there, or you can search for me specifically, Nate Bradshaw. You'll see a picture, of my beautiful bald head on LinkedIn as well. And so we can connect on a DM that way. Those are probably the easiest ways. Either go to the website, go to the contact form on there, and our team would love to get in touch, or reach out to me on a DM on LinkedIn, connect up with me, and be happy to connect you to the right people. So I think that's probably the best way. But like I said too, if someone reaches out and we're not the right fit, and we think that there's some other advisors that would be a good fit, you had mentioned early on, how do people find these advisors? If you just want to hit me up and ask for certain advisors, referrals to tax attorneys, to a really good CPA, to other great attorneys, good estate planning, we'll connect you with everybody that we think is a really great fit. We've worked with a lot. There's some that we love a lot more than others, and we'll put you in the right place.
Thank you so much, Nate.
Yeah, thank you. I really appreciate your time.
Yes,
thank you. You're amazing.
So great. You too.
Yes.
And to you, obviously, subscribe, like, and if you want to have Nate again, I would love to talk to you again.
Love to be back.
Talk about other strategies, or maybe dive deeper into
some
of them.
Let's do it.
So yeah, totally. Thank you so much, and bye.
Thanks.